What did Warren Buffett predict about long-term stock market returns, and how can you consistently beat those returns? So consistently, in fact, that you can plan on it while taking far less risk? I'm Bryan Ellis. I'll tell you how to banish the bulls and bears and just collect the bucks right now in episode number 101.
You're listening to Self-Directed Investor Radio, America's only podcast exclusively for affluent, self-directed investors, where each day of the week you receive innovative investment strategy and deadly accurate market analysis that's untainted by Wall Street and unblemished by government propaganda, all in 7 minutes or less. Coming to you now from iTunes, Stitcher, and SDIRadio.com, here's your host, Bryan Ellis.
Hello, my friends. First, a quick update. The upcoming Passive Property Flipping Summit on August 7th in Phoenix that I've mentioned to you before is 100% full. No more spaces are available. Thank you for filling that event 3 full weeks ahead of time. You people amaze me. I'm so grateful to you. You can still go over to s3flip.com to see the presentation and to get on the waiting list if we have another event. So, how can we safely, consistently whip the returns offered by Wall Street? Well, let's get our objective in clear focus. The lion's share of most individual investors' portfolios are dedicated to the stock market, sometimes in the form of individual stocks and most frequently in the form of mutual funds and exchange-traded funds. Can we beat the results offered by those assets? And by beat, I mean get a consistently better rate of return while experiencing more safety and more consistency along the way? I mean, to my way of thinking, that's the very definition of investment wisdom: strong returns, predictability, and low risk, all of those things together simultaneously. Well, we've got to know what those rates of return really are. And there's nobody better to comment on this than the venerable Warren Buffett. Yes, it's true that Buffett is frequently more concerned about political correctness than with being totally forthcoming, but still, his analysis of what one should really expect from the stock market is rather revealing. In a conversation with Bloomberg, Buffett made a very interesting analysis. He said the economy can be expected to grow at an annual rate of about 3% over the long term, and inflation of 2% would push the nominal GDP growth to 5%. Stocks would probably rise at about that rate, and dividend payments will boost the total returns to 6 or 7%. And you know what? History bears that out pretty well. So 6 to 7% per year, according to Buffett. To make it simple, let's split the difference at 6.5%. I can just hear it right now. Some of you are thinking, 6.5% annually? Ha! I made that much last week on my Apple stock, just last week. And of course you did, and congratulations. Apple has been on a great run lately, except for that brutal fire sale a couple of years ago when Apple plunged over 40% very quickly. Right now, Apple is doing great, and they remind me of Microsoft, the powerhouse software company that could do no wrong in the market until the Justice Department cracked them wide open, and the company was never the same again. Apple reminds me of Texas Instruments, a company whose trajectory in the late 90s makes Apple's rise look dull by comparison, until the market changed, and changed rather painfully very quickly. No, I'm not saying you can't make money in individual stocks. You absolutely can, but there's clearly a huge amount of risk in doing so, and the odds that you'll beat the law of averages is quite scientifically improbable. That's why nearly all individual investors invest either in mutual funds or ETFs. By investing in many different stocks simultaneously, the overwhelming risk of individual stocks is rounded out. But can you and I, as self-directed investors, do better than that? And more importantly, can we do better than that while taking less risk? Substantially less risk? And more importantly still, can we do better than that while having essentially zero volatility along the way? Let's pick a healthy rate of return, let's say 8%. If you could make 8% per year consistently and be paid your returns each and every month and have a risk measurement of your investment be very nearly zero, would you want to do that? Yes, to be clear, I did just ask you if you'd like to substantially beat the stock market every single year, do so predictably and do so with regular cash returns into your account, and do so with an almost unspeakably low level of risk to your principal. Well, I can tell you how, and the truth is, if you want to do it all yourself, you can make more than 8%. But I'll tell you this on the assumption that you would prefer for someone else to do everything for you so that all you have to do is invest your capital and cash the checks you get every single month. Here's how it works. Imagine you have $100,000 to invest. What if you did something very simple with that money? What if you lent that money to somebody else at 8% interest? They'll make an interest payment to you every single month, and at the end of the period of time, whatever you choose, maybe 2 years, 5 years, 15 years, whatever you choose, they pay that $100,000 back to you. And all the while, you've been receiving interest payments directly into your pocket every single month, yielding a consistent, predictable 8% return on your investment. Answer this question for yourself. If that could be done, and it could be done absolutely safely, would you be interested? I'll tell you how it can be done very safely in just a moment, so relax, okay? But answer this for yourself. If you could, with overwhelming safety, collect a consistent, predictable rate of return of 8% on your capital, would you do it? Now, not everybody would, and that's okay. But many of you understand with gut-level instinct why this makes so much sense for your specific portfolio. So for those of you who get it, for those of you who resonate with the opportunity to make a consistent rate of return that whips the stock market averages and does so at an infinitesimally small fraction of the risk that you have to take in stocks, well, to you folks who get it, here's how we do that, and we do it very, very safely. The key, my friends, is a simple concept: collateral. You all know about this. When you got a mortgage to purchase your last home, the bank gave you a loan, but they made you put up your home as collateral. So the deal's simple. If you don't pay, you lose your house. Pretty simple, right? But here's where banks do this poorly, and you and I will do it very, very wisely. Imagine yourself. When you got that mortgage loan, the bank probably required you to make a down payment of 10% or so in order to have some of your own money tied up in the deal. Heck, maybe they even made you put up 20%. The idea is that the more of your own money is in the deal, the more you have to lose by defaulting on your loan, and thus, the more you have to lose, the safer the loan is for the lender. What if you and I took that to something of an extreme? What if, rather than requiring 10 or 20% equity in the property, you and I demanded something much larger, maybe 35%, maybe 50%? If our number was 50%, that would mean your $100,000 would be loaned to someone who could give you collateral, probably real estate, that has a verifiable value of $200,000 or more, and they would pay your 8%. That, my friends, is a safe way to make a very, very strong return of 8%. In fact, if you do the entire process yourself, if you find the borrower, vet the collateral, do the research, make sure that all the legal issues are properly handled, well, it's very plausible for you to make 10% plus through this strategy. But if you want it totally handled for you, where you just write a check and you get to collect interest from a loan that's extremely well secured, well, that can be done for you at a very solid interest rate of 8% in a totally passive manner. So what do you think? This notion of making a loan as a way to invest your capital is very simple. You understand it already. It's also very safe. You understand why collateral is such a great idea too. And 8%, well, Warren Buffett has already shown us that 8% is much better than you'll get from the stock market in the long term. So for those of you who get it, who understand the beauty of a great rate like 8% in a safe, secure, predictable investment, and if you've got at least $50,000 of liquid capital and want to know how to make it happen for you, easily and automatically, just text the word GETEASY8 to 33444. I'll give that to you again. There are no spaces in this word. It's GETEASY8, spelled GETEASY, and the number 8. Text GETEASY8 to 33444, and I'll be happy to get back to you. My friends, as always, invest wisely today and live well forever.
Thank you for listening to Self-Directed Investor Radio with Bryan Ellis. Don't miss a single episode. Be sure to subscribe to Self-Directed Investor Radio right now on iTunes, on Stitcher, and at SDIRadio.com. Your feedback is always welcomed via email at feedback@SDIRadio.com. This show is for entertainment purposes only and is not intended as legal or professional advice for your situation. Content is the property of the Self-Directed Investor Society.